When most people hear the words stock market crash, their first reaction is fear. They picture their retirement accounts shrinking overnight, businesses collapsing, and years of savings suddenly losing value. Investment. And it's true. A crash can be devastating if you're unprepared. But here's the reality. Some of the greatest fortunes in history weren't built during booming markets. They were built during downturns. A crash doesn't have to be the end of your financial journey. It can actually be the beginning of your wealth building story. If you know how to position yourself in times of crisis, opportunities shift. Assets go on sale, investors panic, and money moves differently than it does when the economy is strong. If you can learn how to protect yourself, how to think long term, and how to position your money strategically, you can come out of a crash not just surviving, but thriving. This isn't about gambling or trying to time the bottom of the market. It's about building a plan that works in any condition, even when everyone else is panicking. Today, I'm going to break down exactly how you can build wealth during a market crash. We'll talk about securing your cash flow, identifying the assets that actually thrive in uncertainty, using market downturns as buying opportunities, and building wealth outside of the stock market altogether. By the end, you'll see that a crash isn't something to fear. It's something to prepare for. And if you play it right, it's one of the biggest wealth building opportunities of your lifetime. When it comes to building wealth during uncertain times, the first and most overlooked step is having cash flow and reserves in place. This doesn't sound glamorous compared to buying stocks at a discount or spotting the next big investment trend, but it's the foundation that allows every other move to work. A crash is brutal because it strips away security. If you're overextended, living paycheck to paycheck, or relying solely on investments that just lost value, then suddenly you don't have options. But when you create strong cash flow and maintain emergency reserves, investment, you give yourself control at the exact time when most people lose it. Cash flow isn't just about your income from a job. It's about the money that consistently comes in regardless of the market's ups and downs. For some, investment, that might be a rental property that provides steady rent, even if property values fluctuate. For others, it could be a small side business or skill-based service that produces income outside of their regular paycheck. And the point is that during a crash, income that you can count on is your lifeline. Stocks can lose half their value in weeks, but if you have cash flow coming in every month, you can pay your bills, cover your expenses, and avoid the worst mistake people make during a downturn: panic selling. Emergency reserves are equally important. Imagine the market falls by 30% and your investments drop with it. If you don't have cash on hand, you may be forced to sell at the very bottom just to cover an unexpected expense. That's how small problems snowball into financial disasters. On the other hand, if you have a reserve fund of 6 months to a year's worth of living expenses, you don't need to touch your investments. You can let them recover while using your reserves to cover any bumps in the road. That alone can mean the difference between building wealth and wiping out years of progress. The reality is that most people don't prepare for this. When the economy feels strong, they overspend. When credit is cheap, they take on debt. When the stock market is going up, they invest everything without leaving a cushion. Then, when the crash inevitably comes, they find themselves over-leveraged and exposed. The irony is that the investors who come out of a crash wealthier than before aren't the ones who take the biggest risks. Neither the ones who played it safe enough to weather the storm, so that when everyone else was scrambling, they had the ability to think long term and invest wisely. Let's look at an example. Suppose someone is making $5,000 a month and their expenses are around $4,000. If they're spending everything they earn, they're leaving themselves vulnerable. But if they can find a way to cut back, even by $500 a month, that's money that can be redirected into building a reserve. Over a year, that's $6,000 sitting in cash, ready to protect them. Add another side hustle bringing in $500 to $100,000 a month, and suddenly they have breathing room. Now, when the market crashes and others are panicking, investment, they're not worried about making rent or paying the bills. They're in a position to buy assets at a discount instead of selling in desperation. What's powerful about this strategy is that it's not about timing the market. It's about controlling your personal economy. No one can predict when a crash will happen or how long it will last. What you can control is how resilient your financial situation is before it comes. If your lifestyle requires every dollar you make, then a crash is devastating. But if you build a buffer through cash flow and reserves, then a crash becomes an opportunity. This doesn't mean hoarding all your money in a savings account and never investing. That's not the point. The point is balance. You want enough liquidity to handle emergencies and maintain stability, while still putting your money to work in investments for the long term. Think of it like building a house. You don't skip the foundation just because the roof looks nice. The foundation doesn't get much attention, but without it, everything else collapses. In practice, this means setting a target for your reserves and sticking to it no matter what. For many people, 6 months of expenses is a good starting point, but in times of heightened uncertainty, aiming for closer to a year isn't excessive. It also means focusing on multiple income streams instead of just one. Relying entirely on a single job or a single investment makes you fragile. Investment. Diversifying your cash flow sources makes you resilient. When you have this safety net, you approach crashes differently. Instead of seeing them as threats, you see them as opportunities to grow. While others are worried about how they'll get by next month, you're thinking about how to deploy capital into assets that will rebound and grow. Investment. That's the mindset shift that separates those who lose everything from those who build generational wealth. In the end, cash flow and reserves aren't about playing defense forever. Investment. They're about creating the stability that allows you to go on offense when everyone else is too scared to move. And when it comes to building wealth during a stock market crash, that stability is your greatest advantage. When markets fall and uncertainty spreads, the natural reaction for most people is to pull their money out of everything and sit on the sidelines. Fear drives investors to liquidate positions, stop contributing to accounts, and hoard cash. While having reserves is crucial, this approach often misses the bigger picture. Not every asset suffers in a crash, and in fact, some assets thrive when the economy is under pressure. Building wealth during these times requires a shift in mindset. Rather than running away from investing altogether, you identify and lean into assets that are positioned to perform in volatile or declining markets. Historically, certain industries and asset classes have proven to be defensive. Take consumer staples, for instance. People may cut back on luxury items during a downturn, but they don't stop buying groceries, household products, or basic healthcare items. Companies that provide essentials tend to maintain steady revenues because demand doesn't disappear when the economy slows. Investing in these types of businesses during uncertain times can create stability in your portfolio. While you may not see explosive growth, you're likely to see consistency, and that consistency becomes valuable when everything else is falling apart. Bonds are another example of an asset class that can provide balance. When stock prices collapse, bonds often hold their value better, and in some cases, even rise as investors seek safety. Long-term government bonds, in particular, have historically been seen as a safe haven. Investment. While they may not generate the highest returns, they act as a stabilizer that reduces the overall risk in your portfolio. During a crash, that stability is what prevents panic. If all of your investments are correlated to the stock market, then a crash takes everything down with it. But when you diversify into bonds and other low-risk assets, you create a cushion. Beyond bonds and staples, alternative income streams also become powerful wealth-building tools during downturns. For instance, dividend-paying stocks can continue generating cash flow even when share prices are lower. The key here is to focus on companies with a strong history of maintaining or even increasing dividends during recessions. These businesses often have strong balance sheets, reliable cash flows, and a track record of weathering economic storms. By holding these, you're not just relying on share price recovery. You're being paid consistently while you wait. Real estate can also play a role, though not in the way most people think. Property values may decline during a crash, but rental demand often stays strong. People still need a place to live regardless of the stock market. In fact, in some downturns, demand for rentals increases as fewer people can afford to buy homes. Owning income, generating real estate can provide stability through rental payments, even if property valuations temporarily dip. For investors, investment, that cash flow acts as a buffer that smooths out the volatility of paper assets. Another asset class to consider is commodities, particularly those that tend to rise when inflation spikes. Gold, for example, has long been considered a hedge against uncertainty. While it doesn't always move in direct opposition to stocks, it often provides a layer of protection when traditional markets struggle. Commodities like oil or agricultural products can also offer value in certain economic conditions, particularly when supply disruptions occur during recessions. These aren't necessarily long-term growth vehicles, but as part of a diversified portfolio, they help reduce overall risk exposure. The mistake many investors make is thinking diversification means owning a bunch of different stocks. But if all those stocks are in the same sector or behave the same way when markets fall, you're not truly diversified. Real diversification is spreading across different asset classes, stocks, bonds, real estate, commodities, and income generating alternatives so that no single event can wipe out your wealth. It's also worth mentioning that diversification extends beyond financial assets. Building skills that allow you to generate income regardless of market conditions is an overlooked form of wealth protection. For example, a person who has the ability to freelance, consult, or run a side business is less dependent on the performance of their investment portfolio. This is another layer of resilience that helps you thrive when others are struggling. The point isn't to scatter your money everywhere blindly. And it's about being strategic and identifying which assets are likely to remain strong when others falter. By allocating capital into areas that are defensive, income producing, or counter-cyclical investment, you're not just protecting wealth, you're setting yourself up to compound it when the market eventually recovers. Crashes will always cause panic among those who are all in on risky assets. But for the disciplined investment, they highlight the importance of balance. By holding assets that thrive in uncertainty, you can stabilize your portfolio, generate consistent income, and maintain the confidence to keep investing. And that confidence is what allows you to keep playing the game while others are forced to step aside. And when the recovery inevitably comes, you're already positioned not just to regain lost ground, but to move far ahead. One of the greatest misconceptions about stock market crashes is that they are purely destructive. Yes, portfolios lose value on paper, fear spreads, and it feels like wealth is evaporating. But history shows something very different. Crashes often set the stage for the biggest wealth building opportunities. The difference between those who lose everything and those who come out ahead is perspective. Instead of seeing a crash as a disaster, the smart approach is to see it as a temporary sale on assets that will regain value over time. The key lies in discipline, psychology, and strategy. The first step is understanding the emotional side of investing. When the market drops 20-30%, even 50%, fear becomes overwhelming. Headlines scream about doom, commentators predict depression, and friends and family tell you to sell before it's too late. This is the moment when most people panic and lock in their losses. They sell at the bottom because they can't stand the emotional pain of watching their portfolio shrink. But if you zoom out and look at the long-term history of the market, every single crash has eventually been followed by recovery and new highs. Selling in panic is how wealth evaporates. Holding steady and even buying more is how wealth is built. Dollar cost averaging is one of the most powerful ways to take advantage of a crash without having to predict the exact bottom. By investing a set amount of money on a regular schedule, whether weekly or monthly investment, you automatically buy more shares when prices are low and fewer when prices are high. Over time, this averages out your cost basis, allowing you to accumulate assets at a discount without the pressure of trying to time the market. During a crash, this strategy works especially well because your consistent contributions pick up far more shares than they would have at higher prices. Consider an example: if you were investing $500 a month into an index fund and the market fell 40%, your money suddenly buys 40% more shares than it did before. Fast forward a few years, when the market recovers and reaches new highs, those extra shares you picked up during the crash are now worth significantly more. It's the discipline of staying invested and continuing to buy when others are too scared that creates the wealth building advantage. Patience is also critical. A crash doesn't resolve in weeks. Sometimes it takes months or even years for markets to recover. That's why having cash flow and reserves in place matters so much, because it allows you to avoid dipping into investments prematurely. If you can leave your money untouched and continue adding to it, then the recovery works in your favor. The stock market historically rewards long-term investors who can withstand temporary pain. Those who sell and try to time the market almost always end up worse off. Another powerful mindset shift is to see a crash as a clearance sale on assets you already believe in. Think about it like this: if you loved a company at 100 per share, why would you not want to own it at $60 or $70? The fundamentals of strong businesses don't vanish just because the market is in free fall. In fact, downturns often expose which companies are truly resilient and which were only thriving during easy times. By studying fundamentals and sticking with quality, you can use crashes to buy into strong businesses at valuations that would have been impossible in a booming market. The psychology of fear versus greed is what drives markets in the short term, but the fundamentals of value drive them in the long term. When fear pushes prices lower than a company's true worth, disciplined investors step in and benefit. The irony is that the majority of wealth is built during times of fear, but only a minority have the courage to act. This doesn't mean blindly buying everything. It means selectively choosing investments you believe will endure and grow over the next 10 to 20 years. It's also important to recognize that crashes can reshape entire industries. Some sectors recover stronger than ever, while others fade away. For example, investment technology after the dot-com bubble or housing after the financial crisis eventually rebounded and created massive wealth for those who stayed invested. By paying attention to long-term trends and societal shifts, you can identify which areas are poised for growth and use the downturn to position yourself early. Ultimately, using a crash as a buying opportunity requires preparation and mindset. You prepare by having reserves so you're not forced to sell. Investment: you strengthen your mindset by reminding yourself that crashes are temporary, but assets purchased at low prices can generate long-term gains that are life-changing. Every market decline feels different in the moment, but the story repeats itself. And fear takes over, prices fall, opportunities appear, and eventually recovery comes. Those who keep investing during the darkest times often end up with the brightest financial futures. In short, Wealth during a crash isn't built by avoiding the storm. It's built by having the courage and strategy to walk through it. Crashes reward patience, discipline, and perspective. When others see devastation, you see discounted opportunity. That mindset shift is what transforms a downturn from a crisis into one of the greatest wealth building events you'll ever experience. Relying solely on the stock market to build wealth is one of the biggest mistakes people make, especially during times of economic uncertainty. A crash exposes this weakness instantly. If your entire financial life is tied to equities, then when the market falls, so does your sense of security. That's why true wealth building requires looking beyond stocks and creating multiple streams of income that don't move in the same direction. The stock market is a powerful tool for long-term growth investment, but it should be just one piece of a much larger puzzle. One of the most effective ways to build wealth outside of the stock market is through real estate. Unlike equities, which can swing wildly in value in a matter of weeks, real estate tends to move more slowly and is driven by different factors such as local demand, interest rates, and housing supply. More importantly, real estate offers something stocks don't: consistent, tangible cash flow. Rental income can provide stability even when property values temporarily dip during a downturn. People always need a place to live, and that creates an opportunity to generate passive income while still building long-term equity in a property. When the stock market crashes, steady rental checks can be the difference between financial stress and financial resilience. But real estate is just one example. Another critical area of wealth building is creating income streams through skills and businesses. Think about it. Your ability to generate income outside of a traditional job or the stock market gives you independence. A side hustle, small business, or freelance skill not only supplements your income during good times, but it also acts as insurance during downturns. If the market falls and job security becomes uncertain, having the ability to earn on your own terms is invaluable. It might be something as simple as consulting online services or selling products, investment, but that additional stream of revenue diversifies your personal economy, just like multiple asset classes diversify your portfolio. Investing in yourself is another overlooked but powerful strategy. Building wealth isn't just about what you own. Investment. It's also about what you know and the skills you can leverage. Developing expertise in a field, learning new high-demand skills, or even expanding your network creates opportunities that compound over time. Unlike the market, investment, which you can't control, your personal growth and skills are entirely in your hands. During a crash, the people with valuable skills often come out ahead because they can adapt, create value, and seize opportunities that others can't. That adaptability becomes one of the strongest forms of wealth. Another area worth considering is building income through digital assets or intellectual property. For example, content creation, online courses, or licensing work can generate revenue streams that continue regardless of market volatility. The digital world has opened up avenues for passive income that weren't available to previous generations. While these require effort up front, once they're established, they can provide consistent returns with minimal ongoing involvement. Just like a rental property pays you month after month, a well-structured digital asset can do the same. Diversification outside the stock market also includes exploring conservative financial vehicles like bonds, treasury securities, or even high-yield savings accounts when rates are favorable. Investment. While these don't provide the explosive returns of stocks, they protect your capital and give you flexibility. During a crash, having assets that retain value or even increase in demand gives you the confidence to hold your ground while others panic. It's not about maximizing every dollar of return. Investment. It's about building a system that can withstand any economic condition. It's also worth mentioning that building wealth outside the stock market doesn't always have to involve money directly. Your health, relationships, investment, and lifestyle choices all contribute to your ability to generate and preserve wealth. Poor health can drain financial resources, while strong health can enhance productivity and longevity. A supportive network can open doors to opportunities and partnerships and ideas that no investment account can match. By investing in these areas, you create a form of wealth that supports your financial life in ways that aren't always measurable on a balance sheet. The key idea here is resilience. The stock market can and will experience crashes, sometimes more than once in a decade. If your entire wealth strategy depends on the market, then you'll always be at the mercy of forces beyond your control. But if you spread your efforts across real estate, side businesses, skills, digital assets, and conservative instruments, then no single downturn can wipe you out. You'll always have something working in your favor. When you look at the most financially secure people, they don't rely on one income source or one type of investment. They build layers of wealth that support each other. If one area slows down, another picks up. That's how wealth is protected and compounded over decades. The stock market remains an important piece of the puzzle, but it's never the whole picture. Ultimately, the goal is to build a financial life that isn't fragile. You don't want your wealth to crumble the moment the market dips. By creating income streams and assets outside of stocks, you not only survive a crash, you thrive in it. You're no longer dependent on a single outcome. And that freedom is the truest form of wealth you can create.